you have everything you need. Now you can be an expert volatility trader. Finance family, it's your other brother Adam Getbags, and it's a volatile time in the market, so it's only right that I'm bringing to you the full and complete guide volatility analysis. All right, we got a ton of stuff, so stay tuned to the end. We got efficiency at the end, and I think that's very important. So if you're doing scanners and you're scanning for volatility, it's going to be super helpful. And also if you're trading options, it's going to highlight issues that have high volatility. So if you're selling premium, it's going to be great for you. So we're going to be adjusting candles for splits and dividends. We're going to be normalizing our candle heights, measuring drawdowns, do rolling range over price calculation, log return Z-scores, candle height Z-scores, rolling average, log returns and standard deviation, rate of change. We're going to do that true range and average true range calculations. And at the very end, we got efficiency. And then of course I threw in some quantiles in there for you as well. And then we have a correlation matrix at the end so we can see which of those measures are highly correlated if we just want to get rid of some of them. Okay, so it's only right that I bring it to you. Hope everyone's doing okay out there in these crazy choppy markets. So I have our equity volatility analysis up here. First thing, we import our modules. We're going to assign a ticker here to take a look at. PBF, they do pay dividends. All right, and then we have start date and end date. And then we're going to make a Yahoo data request just to keep things simple. Not everybody has the TD API set up, so I have both, so you can check those out. We have the log returns here. And then next we're going to calculate an adjustment ratio, because in the Yahoo time series, open, high, low prices are not split or dividend adjusted. So we're going to create this adjustment ratio, which is adjusted close over the regular close price. And then we can adjust our open, high, low prices by multiplying open times your adjustment ratio, low times adjustment ratio, and high times adjustment ratio. Next, we have our normalized candle heights. So to get your candle height, you just subtract the low from the high, and then we divide by price so that it's a percentage of price there. This adjusted candle height, you can use this as a measure of volatility, obviously. So the size of the candle is going to be a measure of how volatile, the day's price action was. We have our min-max range and points, no problem there. And then we have a calculation here for points off of all-time high. So we take the all-time high, you subtract out the adjusted close price, and that's basically how far the current price is off of the all-time high price. So fairly intuitive, but that's in points. To get your percentage off of the all-time high, you take the number of all-time high points, the number of points that you're down, and then you divide it by the all-time high price. And then that's the first one that we have a chart for. Now this is a percentage, so this zero value is going to be all-time high territory. And then as this goes up, this is how far you are off from the all-time high. Keep in mind, these are adjusted prices, so we adjusted the candles in the beginning. Okay, next we have a rolling high and low range. So here, since it's an equity time series, we have 20 days, which is just 1 month of trading. So we're having a rolling period of lows. So we're finding the minimum low value in the past 20 trading days. Same here with the high price. So now we can create a rolling range of our high-low price. Okay, so we have the range over price. So when we subtract the low from the high, we have a range, but we need to adjust that for the current market price. So it's a percentage, so it scales. And the whole thing about these percentages is that you can compare time series. If a low price stock, you want to compare a low price stock to a high price stock, you need to adjust by the price. Okay, now, so for this measure here, be careful. So you can have a value of over 1 if the time series is downtrending. So you see here, there was a big downtrend in the price, and then this value is going to go up majorly because it's having a large range, but the price that you're dividing by is much smaller. Okay, now it can't be greater than 1 if the stock is at all-time highs or it's uptrending. So imagine if a stock's uptrending and it's like at all-time highs, the lagging range is not going to be larger than the stock price at all-time highs. So that's why it can't be greater than 1. Now next we have the log return Z-scores. So we're just calculating the average of our log returns here over all time and the standard deviation of our log returns over all time, and then doing the Z-score calculation, which is just observation minus average over standard deviation. And that's going to give us a nice chart here. And then you can see how far the daily returns are deviating on a standard deviation basis. Next, we have our candle height Z-score. So similar methodology here. We're taking our normalized candle height, so that's in percentages essentially, and then we are finding the average of that, and then we are finding the standard deviation as well, and then finding observation minus average over the standard deviation, and that'll give you a Z-score. Again, the importance of the Z-scores is that when you're doing comparison between multiple time series, that you're able to compare them regardless of price, so you can compare low and high priced stocks. Next, we have a rolling average standard deviation, so we're just again using that 1 month window. So we have a rolling average of the log returns. So first we have a rolling object, and then we're finding the mean of that window. So the early part of the time series will have nans, and then after you've met the length of the rolling window, then it'll start to calculate the look back average here with mean. And now we have that rolling average log return. So these are average returns over the period. So in this big down move here, we could see the average return, over this time was quite negative. Now we have the rolling standard deviation of the log returns, very similar rolling window theme going on. And you can see standard deviation, which is volatility measure, is just jumping right here during this pullback. This might be something that you'll use in a scanner to find options with high volatility. Of course, how could I not throw in the quantiles? So if we're looking at rolling average log return, we're going to find the bottom 5% quantile, the nearest value. I don't like that. Let's look at the 1%, the bottom 1% rolling average log return. So we're looking at that rolling window, but we want to find values that are in the lowest 1%. So this could be a flag for a screener. And then the interpolation parameter, that has quite a few that you can choose from. So be aware of how that's calculating. So I'm just finding the nearest value if the quantile lies kind of between two values. So here we have, a return of negative 2.8% on average daily over that rolling period of 1 month. Moving on. A rate of change window. So here we have the rate of change calculation, which is just current price minus previous price over the price at the beginning of the period. So if the price was high and then now the price is lower, you're subtracting the higher price, so that's going to give you a negative number, and then you're comparing it to the starting value. So if the stock's going up, then you're going to have a larger number here and a smaller number here. That's going to give you a positive number, and you're dividing it by your starting price as well. Okay, great. And then you're just filling in the nans with 0, just so the chart doesn't look like booty. So you can see right here at the very beginning, it has that zeros there, but no problem. So let's keep it moving here. So rate of change, really intuitive and easy to understand. Your average true range here. So we're using a 20-day average true range. So here's the nuts and bolts of the average true range calculation. So that's all set up there for you. And now we have our average true range in points, and we can check that out. It looks way different than when you look on a percentage basis. So that's in points. And then now here's in percentages. So it looks very different. And all you do to get the percentage, you just divide it by price, because points doesn't give you the full story, but the percentage gives you a much more robust picture. Last but not least, we have efficiency. So efficiency here is the rate of change over the average true range in points, and that's going to give you a scaled value, so you can compare different time series, and efficiency is pretty good. So high absolute values suggest larger moves in a straighter line. So a very high efficiency time series will look like a straight line going up, and then a very high value negative efficiency will be like a straight down. The more volatility, the more zigzag the time series, then your average true range is going to be larger, so your efficiency value is going to be smaller. So essentially it's just that rate of change calculation here, and then you have that rate of change divided by your average true range in points. So we can just check that out, see what that looks like. And then again, the values are varying from negative to positive there. And then that average is looking like it's in the middle. And then last but not least, of course, I have our correlation matrix. So we've reviewed all of these different volatility measures, efficiency at the very end. So good job holding on. Hopefully your brain is spinning. There's a lot of applications that you can use all of these. And we have the correlation matrix at the very end, so that if you want to see if any of these are like too highly correlated, you don't want to use the time series with too high correlations. But you have everything you need. Now you can be an expert volatility trader. There's a lot of info here. So I hope you got value out of this. Let me know what you think in the comments. If there's something you want me to build or expand upon, just let me know. You have my blessing, fam. Stay safe out there. These markets are pretty crazy. Let's go get these bags.